The reasoning behind why you picked that? How did you
Because
arrive?
because this is the popular ETF, which has all the precious metal mining companies. Because precious metal is a strange thing, commodity prices goes up and down. So GDX is just one of the most popular when it comes to precious metal. So I picked it. The same reason I picked S&P 500 or SPY, because that's the most popular index of 500 largest companies in the world. So that ETF is called SPY. It's called Spiders. So SPY, if you buy one share of SPY, which is like $300 a share, you're actually buying a fractional ownership in 500 largest companies in the world. So chances are that all 500 companies are going to go out of business is extremely close to zero. So that's a good, safe way to start. And GDX is the same thing like that for precious metal mining. Anybody else have questions? Anything I can answer?
Is it?
See, got it. So again, Zareen, there is no recording going on. Do you know that? Andali?
Yes.
There is no recording happening. Is
yes,
that
I'm recording.
Okay, it doesn't show that.
It's on my computer, so it's recording.
All right. So yeah, somebody had a comment or question?
Assalamualaikum, I wanted to ask, for ETFs, do you know, are there any ETFs that specialize in say I don't want, I'm not trying to bring religion into this or anything, but just specialize in say Muslim countries or in kind of, I guess, from or follow like Islamic finance laws or something?
Probably, most likely, because it's a huge market. So I'm not personally familiar with one, but if you just Google the word Sharia compliant ETF, you'll come up. So it should not be hard. So somebody asked the question, Zareen asked the question, is the fee percent is based on total investment or gain on investment? Answer is total investment. So if you put in, let's say, $10,000, so whatever the fee is, it will be subtracted from your account, 1%, 2%, whatever it is, every year, regardless of whether it goes up and down. Yeah. So yeah, Yunus said there is one, just Google it. When you pick something like SPY, you're generally picking low risk over growth. Asim said that SPY is low. So, look at the historical data. SPY or Spider or S&P 500, which is S&P stand for Standard and Poor. So Standard Poor is the name of a company. So they pick the 500 largest company by market valuation. It's very hard to beat S&P 500 index. Most mutual fund, 80 some percent, do not beat S&P 500. So that I would not call that as a low risk. But yes, you're diversifying because out of 500 companies, some go up, some go down. But if you can keep up and beat S&P 500, you are a hero. Some mutual funds and something do beat, because last year was, certain sectors were very hot. So other thing is real estate. Just like you can buy an apartment building, you buy a house, you can rent. Yes, that's all great. But you can also buy REITs. Real estate investment trust are companies which then go buy other commercial real estate, residential real estate. So again, they pool money for a whole bunch of things so they can buy those, and then they distribute the profits to the shareholders. And they go up in value because the underlying asset is going up in value. So this could be an easy way to invest in real estate without all the hassle of real estate. And Kamran asked the question, do mutual funds still exist with the advent of ETF? Absolutely. Absolutely they exist, because many people believe, including myself, that a smart manager who wakes up 4 o'clock every morning, every day, and studies all the companies and talks to them and decide what to buy, sometimes they do very well. And I mentioned the most famous manager was a guy named Peter Lynch. He managed a fund called Magellan, this from a company called Fidelity, which is one of the largest mutual fund company. So Magellan Fund still exists, but Peter ran it for 30 years. and he outbeat all market indices like 34% annual return for many years. He wrote a book on this. If you want to read a book about stock market investing, look for Stock Market Book by Peter Lynch. So yes, they do exist, and they do well. So again, feel free to unmute yourself, ask any questions. Second thing is that there are different indices. I mentioned the S&P 500. So this is weighted average based on market cap. You all hear about Dow Jones Industrial Average. Did you know that Dow Jones only represent 30 stocks? And these 30 stocks are picked by one guy from the Dow Jones Company, which is editor of Wall Street Journal. They change. Sometimes some companies kicked out of Dow Jones, some companies are added, but it's not as representative of the market as S&P 500. The other one is NASDAQ 100, or called QQQ. These are 100 of the largest companies on NASDAQ, which is mostly technology companies. So it represents. So if you don't know what to buy, Apple or Facebook, or what to buy, well, Facebook is not on NASDAQ, Apple is. So NASDAQ 100 represent the, Twitter, all those, you're buying all those companies, we're buying one single share of QQQ. So this could be, if you believe in technology companies are going to do well, you could just buy QQQ, and then you don't have to decide which one to buy, which one not to buy. The one represents all of them. So this is just to show you, like S&P 500 is, say, 500 companies are part of it. So you notice here the weighted average, which comes from their market valuation. So Apple has a much bigger weight, 6.5 units. NVIDIA is 1.13 units. Home Depot is in there. Visa is in there. So look at that. If all these companies you may want to buy, you don't have enough money to buy all of them because Google shares are over $1,000. Well, if you buy one share of SPY, which is S&P 500 index, you're getting a piece of all these companies. That's not a bad way to start. So here you can see how some of these indices did last year. You notice the top line is the NASDAQ 100, QQQ. You notice from last 1 year, it was up 38%, almost 37%. Then the blue line is S&P 500, up 11%. And Dow Jones Industrial Average is the yellow line on the bottom, and that's up 3.3%. This is last year's number. But gives you an idea, they all went down in March when COVID hit. They all recovered very, very well. They hit their high around September and still done well. So all this information is available for free, just going to internet and just type in, performance, stock market index 2020 performance, and all these charts come up, it'll tell you. Now you notice on the chart, how do you read this chart? So each point in the chart is the closing amount, closing value of that day. So index could be up, to 500 points, 470, 485, but it closed at 463 at the end of the day. That's the point representing the value on the chart. So it's the closing price and all this thing on each day. You notice on the bottom, there are lines, vertical lines. These lines represent the volume, how many shares were traded. Red line means stock closed down from previous day. Green means the stock went up from the previous day close. So you can be looking very quickly, you can see that the volume is rising and it's more red, it means stock is going down and it's accelerating, more and more shares are going down. If you see green and volume increasing, that's a positive thing. It means volume is going up every day, more shares are exchanging hands, and it's closing at a higher and higher rate. So once again, I don't have to remind you, you can ask a question, unmute yourself, or tell me if you this is too obvious and boring and you want something else.
I'm going to ask a kind of a simple, silly question. So by volume mean the volume of trade, right? That day.
How many shares changed hand that day?
Okay, so if they just stay in one hand, that doesn't count.
Yeah, so if I sold you 10,000 shares, and then you sold 2,000 shares to somebody else, 12,000 shares changed hand today.
Gotcha.
10,000 from me to you, 2,000. So that volume indicates that more and more trading is going on. Something is up.
So,
you notice
and what
here,
does that? what does that generally indicate?
Indicate there's a lot of interest in that stock. Something is going on. Maybe there's a news or people are anticipating something or good or bad. If volume is increasing and it's more red vertical lines, this means some bad people are anticipating bad news. Stock is volume is increasing and things are going down. Some panic is setting in.
So it could mean both.
No, if it's going down, then it's panic is setting in. If it's green and going up, volume is going up and stock is closing as a higher price than previous day. This means there's some good news anticipated. More and more people are trying to buy the stock. So in anticipation of some positive news. So then volume is going up and it's green, not red line. This means closing price is rising. So that means a positive momentum. So this was S&P 500, which is the index. So this is index itself. It's not the stock symbol. Index is 3,585. That's what gets reported on the news every day. Dow Jones Industrial Average crossed 30,000. S&P 500 crossed 3,500. The stock which you buy, which makes up this thing called SPY, Spider. This is the index. SPY is actually what you buy, the stock you buy, symbol you buy. So how do you decide what to buy? Well, there are several methods. There are as many methods as there are people interested in stock, apparently. So one is fundamental analysis. So here you look at what is the price earning ratio? What is the volatility? Is the earnings going up or earnings going down? So you do this kind of fundamental analysis. Then some people look for value, that something bad happened to the company, and just because there was a momentum, people start selling the shares, stock went down. So an example would be, Chipotle, there was a big scare that Chipotle's people got sick. So nothing fundamentally wrong with Chipotle as a company, but just people got panicked and start dumping the stock. Stock went down a lot. So that's a value stock. It has unusual value because people are emotional and hurt. They dump the shares, but fundamentally nothing wrong with the company. Some of you who are not old enough to know, many years ago, I think in the 80s, there was a contamination in Tylenol. So the company who makes Tylenol, the stock really fell down. As we know that, I think it's Johnson & Johnson, whoever makes Tylenol. They recovered. They came up with some kind of a child-proof cap, tamper-proof cap. Things got fixed within a year, but that was an unusual time to buy the company. After an airline crash, airline stock just goes down. Fundamentally, nothing wrong with the airline. So that could be a good way that's a value trading. The third thing is technical trading. Technical trading means you're purely buying based on numbers. You can almost close your eyes and don't even know what the company does, but you're able to make a decision based on some technical analysis, which I'll share with you what that is. So like I mentioned, value is when it's unusually low for some reason, and you can look for the opportunity and buy something is low. So guess who is famous as a value investor? Warren Buffett. So he's famous because he has the money lying around. So when bad things happen, he comes in. So for example, when 2008 crisis happened, all the big companies were going out of business. Goldman Sachs is the top brass gold standard name. They really needed money to stay solvent. So Warren Buffett came in, he negotiated a sweetheart deal. He did something called PIPE, which is a private investment in public entities, and he got preferred shares with paying dividend and right to buy additional shares. He made a pretty sweetheart deal, and he ended up making hundreds of millions, if not $1 billion gain on that situation. So he's a value investor. Growth investing is, yeah.
I'll ask another newbie question. So to me, it sounds like to be a value investor, not only do you need to understand how that industry is working, you need to kind of have a good grip on how things work in that industry, but you also need to understand how that company is operating. What's their business model? Is it solid?
Yeah.
What's their operation model? Is it good? Is it going to survive? Is it going to sustain?
Exactly.
Only based on that you can make a call, say, yeah, it went down by 40% today, but I don't think it's going anywhere. So you
You're
need to be
correct.
kind of a real guru, and I don't know how Warren Buffett does that with so many companies, but
Because he has probably several dozen people doing all that analysis for
doing
him.
it. Okay.
Yeah. So yeah, that's what mutual fund managers do. That's what they have dozens of young MBAs from Harvard crunching numbers for them, and that's how they decide. That's right. The people have to do a lot of thinking and analysis.
So
That's what a lot of
to risk averse people like me, it doesn't sound like something you should just jump into when you're beginning into the stock market. Based on your hunch and say, hey, yeah, I don't think Apple's
so
gonna
see the
trade.
thing is the risk averse people. I don't know what that means. Uh, if you're risk averse people, then you keep money in the money market and just not worry about stock market. The that issue is that if you look at historically, stock market over the last 100 years has produced about 10 to 11% a year annual return. So if you are not freaked out about any day up and down, long term, you should do extremely well. And I'm going to show you some data in a few minutes. So it's all about having a mindset that if you need the money next year for an operation or buying a house, then you'd probably stock market is not the place to go. But if you are in your 30s and someday you'll be retiring, that may be the best place for you to keep your money so it grows. And we're gonna get into that in the next few minutes.
Gotcha.
So then technical trading, let's start what is technical trading. So technical trading is that market already knows it all. This is Warren Buffett's phrase, by the way, Mr. Market knows it all. All that speculation about new product, about what's going up, what's going, market has factored all those things in already. So the price is already the fair price. So technical trading is you're not smart enough to know all those analysis you just talked about. You just catch a moving train, meaning a stock is already has begun to rise. If certain metrics are met, you jump on that train and you set up an automatic signal when somebody will kick you off the train. If you consistently follow that formula, there's a pretty good chance that you will do well. This requires three things. First, admitting in the mirror that you're not smart, you know nothing. You know nothing about the company, and I'm not going to listen to my heart. I'm only going to look at the numbers. Number two, you're not trying to buy something at the lowest price or sell at the highest price because you don't know what that is. And number three, all emotions are taken out. Decisions are made purely on numbers. It's very hard for people to do this, but that's what technical traders do. So I've given you some rules here. So 25% trailing stop loss means that automatically you set a signal that stock drops 25% below is whatever high is, automatically sell my shares. So you bought it as shares. So you set a price, suppose stock is going to do like this, whatever. You buy here, you automatically set a stop that I'm buying at $50. If it ever goes below 25% below that, $37.50, sell the shares. Suppose stock moves up to $100. Trailing stop loss mean your stop signal also moved up. So what is 25% below 100? 75. So here your stop loss was at 37.50. Now, when stock went to 100, your stop loss went to $75. If stock dropped to $60, you'll automatically sell right here at 75. So then you can buy again based on the formula you may buy it here, it'll automatically be sold over here. So setting this disciplined approach works well. And I'll show you some other charts, but this is the overall rules. You take advantage of something called moving averages. Now, this is basically average of the last 5 days, 70 days, 150 days, 200 days, whatever. And in Yahoo Finance, you can just simply pick those numbers and it will show you the chart. And I'll show you what they look like. So let's look at this chart. This is IBM from 2002 till 2020, IBM stock. What I'm showing you here are two lines. The red line is 161-day moving average. That's the red line. The blue line is 70-day moving average. That's the blue line. So this is method I use. So you notice here when blue line crosses the red line, you want to buy the stock. When blue line goes below the red line, you sell the stock. So let's just follow these simple rules. What we would have done, we would have bought IBM right here. It was probably what, $100, something like this, $89. And then we would have kept it and sold it here. So it was probably what, like $120 maybe. Then we buy it here again, and we would have kept it till here. We would have ridden the stock from approximately 110 to all the way, whatever that is, 185 maybe. Then we would have automatically sold it. Then we would buy the stock here somewhere and sold it here and would not be overruling the stock. So these decisions make suddenly easy when to buy, when to sell, if you follow some rules like these. I'm not sharing the chart. You're not seeing the chart. What is that?
We see it.
Okay.
We see it.
No, we can see it. Like,
All right. So some Asad Ali said that. So okay.
yeah, but I think something with his
Yeah.
setting.
So
So
question for you.
yeah,
When you say blue line, red line automatically, what is the proper way of, what is a platform for doing that? And can we set it up over time to do automatic blue line, red line swaps?
maybe you can automatically. I don't know. I'm sure there are somebody has invented an app which does that. I've not researched it, but it's not complicated. So let me show you how to do that. When I want to cover other topics too, but okay, maybe I can show you quickly. Let's see, where is my browser? Let me show this screen. So I'm going to go to finance.yahoo.com. Okay, so let's look at some many share. Let's look at S&P 500 even. You can just, let's put in SPY. This is S&P 500. And it brings up S&P 500, but I want to look at SPY, not S&P 500. SPY, which is a stock I can buy, a symbol, which is a $380. So that's what it is. Okay. So now this shows you some details about it. What's the yield, which means if you own a share, you get $1.54% yield, which is, by the way, better than what you get at your bank account. So if you owned like a $10,000 worth of shares, every year you can expect a check for $154 as a yield, because all the stock paid dividends, many stock. So it has some other detail how much, but let's focus where we need to go. We want to go to, where do we want to go? I want to go to charts. I'm looking at charts. Oh, here we go, charts. Okay, so this is showing me S&P 500. So it was here, it went down during the .com, the March post-COVID went down to 240. Now it's been going up since 240. It's at 380 right now. You can see up and down. So then you want to, for example, you can do an interactive chart. You can do a line. You can draw. You can do different things. So let me see. Where do I do moving averages? I can compare that with other indicators. I can do different charts. Where is my, I can do different intervals, historical data, option holding. Somewhere here I can do moving averages. Where
It's under indicators appears.
Is it under? Okay, moving averages, that's good. So I'm gonna do moving averages. I'm gonna do, let's say, on my different people use, my is 70-day exponential, and let's call them moving averages. And then I can do also 161-day exponential. Let's change the color to a different color. Let's say red.
Can you
How
touch
did you
on
come up
why,
with those values?
One more time.
especially the exponential part? How do you choose exponential versus simple?
Because I took a course and that's what they taught me.
All right, do share.
Yeah, I want a different color. This color is 72 red or something. Not a fun color, that's a fun color. Okay, so now here we know. So this would have told you where to, the third one, which by the way, I like to follow is 5 day. That's much more faster, more quickly buy and sell. Let's add that for fun because those are the three I follow. So we'll add, we'll use that black or something and we'll do the 5 day. Yeah, so 5 days actually is, it's not, it's too much like the stock. I'll ignore the 5 day one, that's not fine. So this tells you when I would have bought the stock right here at this price because the red line crossed the blue line. So I would have bought at 311 and I've been holding it. I would have ignored all these dips because I'm still safe. If I had bought it, I would have sold it right here when stock went down. We don't know how far it was going to go on, could have kept going. So let's do this thing on a different stock, which is more volatile. Well, the most volatile stock is probably Tesla. Let's see how bad that looks because this was a very safe stock, S&P 500. So let's go look at the chart of Tesla. It's so complicated, it's taking a long time. So Tesla, this is 218, maybe this is too far away. Let's look at just maybe 3 months. 3 months is not very interesting. 1 month is it's always going up. Okay, let's look at 2 years. Yeah, it's always would have bought it and kept it because it kept going up. What's a volatile stock which has gone up and down quite a bit? What will be a good example of some stock like that?
GameStop.
Okay, yeah, that's probably a terrible thing to look at. Probably does not even apply here, but let's look at it for fun.
You can check Apple as well.
Apple
Apple is very volatile these days.
Yeah. So the point is it's not difficult. It's all free. It's all available. You can do here. But I do want to go back to the 401k topics too. So what is CLSK, by the way? Yeah, see, this crazy, it was like flat, like zero, then it just shot up. That's not an interesting one to look at. It's really weird. I think Apple is probably a good one.
Sure. No, I wasn't meaning to distract from your talk. It was more of, is there
Yeah.
a platform that does it automatically for the sell point, or you manually tell your trading to sell it?
Okay, I'm doing manually, but there probably are platforms which
I see.
when
I
I
see.
was actively doing, right now I'm too busy teaching and running companies, I'm not paying attention to this. But when I was paying attention, this was 10 years ago when I took the courses, there was no platform, we had to manually do it. I understand
see.
now there are platforms probably who do that. So Apple would have been an easy one. Look at Apple.
Now on the brokerages, there are, you can automatically set up trailing stop loss and they do it for you. All the brokerages do that for you.
The trading stop loss they do. The question is moving average crossing over and then trigger a buy and sell. To my knowledge, that they don't do that. Do you know if they do that?
Yeah, that they won't do that, obviously.
Yeah, exactly.
I don't think anyone does.
All that
Okay.
happened, that is correct. So Apple is interesting. Look, if you followed this method, you would have bought Apple last time when it crossed this line was $61 and you still be holding on to it. And you would have, it just dipped below for like a day and a half. And then you would have sold it here. So, this, you can see that you can back test this method. Method works. You don't have to be genius. You can put this method of 70 day, 161 days, back test on any stock, you can see the method works. Okay, let me go back to my normal presentation.
Okay, thank you for that.
So, okay, somebody said, what course did I take? So if you want to learn about what course I take, there's a guy named RC Peck. RC Peck, and he has a lot of online courses, and his company is called Fearless Wealth. So I'm putting them in the chat window. So fearlesswealth.com. He used to be in Bay Area. He moved to Seattle, and he is a pretty solid guy. I took many courses from him, and he teaches a lot of that for free, and some he does that for you. So you can check out his website, and if you ever talk to him, mention my name. All right, back to this. Okay, so this is this P&G, Procter and Gamble. You see that again, it tells you I would have sold the shares here, bought it here, made a little bit of money, sold it when it crossed here, and bought it back again, and would I still be keeping it? Would have gone through all this ups and downs. So
what was the name of the courses? It did not come through in the chat for everyone. or at least did not come through for me.
When you go to the, oh, sorry,
Hmm.
I sent it to
Yeah, I
Farha,
don't see it either.
not to everybody. Okay, my mistake, sorry. Let me fix this problem.
Oh, okay.
Yeah, I just send it to one person because that's the person I was talking to.
Maybe that's your favorite person here
Maybe.
then.
So you can, this guy's name is RC Peck. You can Google him. He has lots of videos, and a lot of videos are free. So RC Peck, bande ka naam hai, and then Fearless Wealth. So you can just, just Google it and check it out. So, he sort of talks about how to emotionally disconnect from stock market, how personal finance. So I've taken a lot of courses from him. He's got more than $10,000 I've spent with him, maybe 20. I'm summarizing all that knowledge to you in this talk. Okay, so notice here, Johnson and Procter and Gamble, this would have worked. The method would have worked. Okay, so you can see here, moving average 70 days and 161 days. That's the two moving averages I watch. This shows, if you just go to like this Charles Schwab, I do with Charles Schwab, you just put in, there's a tab called research, but you can show you all the different index funds, equity fund, tell them how they did in the last 3 months, 1 year, 3 year, 5 year, and all kinds. Then if you want to buy one of them, you just say trade, and you can do that. So it's not complicated. All data is available for free. It's not, nothing is hidden about this. It's very easy to find what's going on out there. And this is many places, Schwab.com, you can buy mutual fund, you can buy stock, you can buy option. Fidelity is the same way. Vanguard is a nonprofit. They especially specialize in mutual fund and index fund, and they're usually the low cost leader. They don't charge fees as much as others, so they're really very economical and a good place to go, based in Pennsylvania. But Schwab and Fidelity, you have offices in Silicon Valley. You can walk in there, sit down with some consultant, and they'll help you set up everything. So it's not, I've been with Schwab 25 years. Okay, so now the one question somebody asked, what's a good time to get in? So I want to introduce the concept of something called dollar cost averaging. What means is, since you don't know when the stock market is high, when it's low, so it's trying to outsmart it, you put some fixed amount every month. When the market is high, you get fewer shares. When market is low, you get more shares. Because in this example, you put $30 every month. And in the beginning, stock, this price was $30 a share, then became $15, $10, it fluctuated. But your average price was $21 a share. So usually, this is a good way to enter stock market. You don't know what the high is, low is. You put a little bit every month. So suppose you had $20,000 to invest. You may want to consider putting $3,000 every month over the next 7 months. If stock market goes down, you buy some more shares, but you have a disciplined approach. It's the discipline which is important. I'm going to switch gears to this topic. Any remaining question on stock before I make a switch?
Anything on SPAC stocks?
Avoid them. SPAC is a special purpose vehicle for going public. So people can start a company with no asset, nothing in it, just on their reputation. Because going public is an expensive process and a lot of regulatory compliance. So when you're trying to go public, you have to pass all kind of approval from Securities and Exchange Commission and cost millions of dollars. So a lot of these famous people whose reputation is good, they take a blank check company public. Company has no asset except a promise that you will buy a good company once you're a publicly traded shares. Because when you're a publicly traded company, you can sell shares to public, you can raise money. So then those companies then merge with a real business. So it's for a normal company like my own company, this is a less expensive and faster way to achieve liquidity by merging with a SPAC. And then you can raise more money to run the company. So it's an alternative to going public, which is a highly scrutinized process. And SPAC stand for Special Purpose Acquisition Company. So this is lately, in the last 1 or 2 years, it's become very popular because a lot of speculation happens. So, in general, if you are a normal investor, stick with the fundamentals. When you have millions of dollars, then you can play with SPACs, because then by that time you'll have advisors.
Thanks.
Okay, is this topic relevant? Should we switch to this topic? Or if everybody knows everything about it, I can skip this topic.
No, it's good.
No, it'll be useful.
Okay. So let's take a look. So this is one of the questions which we asked earlier. If you had invested $1,000, in 1988, by 2018, which is 30 years, how they would $1,000 would have become almost $10,000 in U.S. stock market. In the small cap, which means companies which are smaller total valuation, small capitalization, would have been even higher than that, maybe $11,000. In gold, this would have become $1,800. In real estate, close to $8,000. So the point is, many of you are afraid to invest. You call yourself low risk people, but money sitting in the money market or checking account not doing you any good. If you had put into any of these instruments, you would have done better than just leaving in your checking account. So my advice is, quit being afraid and distribute some money in some of these instruments, and you'll probably end up being much better off than just keeping it under your mattress or in the checking account, because these are different asset classes. You can distribute, you can put 20% in 5 of them. So let's take a look at some other things. So this is the difference between growing tax-free or not tax-free. This is where IRA comes in. IRA is individual retirement account. So you notice here on the right-hand side, if you had put in $10,000 every year, how money would have grown? If your regular account, if you have grown, it would have grown to some number, which is something like this. But if you're putting that in an individual retirement account, when the gain every year are not taxed, then it would have grown much more. And that's the difference. So what is the individual retirement accounts? Government allows you to put aside some amount of money every year. And as the money grows, you don't have to pay income tax on that growth. It grows tax-free. Normally, if you put $10,000, suppose you gain $2,000, you have to pay tax on $2,000. In an IRA, in a retirement account, you don't have to, until some conditions take place, which we will talk about.
I have a question for this IRA account. If I'm trading in the IRA account, not like long-term investing, I keep buying stocks and I leave them for long-term, but if I'm trading in an IRA account, is it still tax-free?
Exactly. And that's why I love to trade in IRA account, because I don't have to fill out a long Schedule D and tell every trade I make and how much money I made. It's all just cooking by itself. Love it.
I see. All right. Thank you.
What does FM stand for? Is it like frequency modulation?
No, it's Faramamji. My full name. It's just the initials here.
Okay. I said I'm dealing with AM versus FM here. So yeah, so you can see if it was allowed to grow tax-free, then it can multiply much better. In this example, it makes a difference of just under $1 million. It's a big deal. Having 790 versus 1.6 million, that's a big deal. So that's why it'll be silly for you guys not to take advantage of this, some kind of a tax deferred instrument, and you have many to pick from. So let's take a look here. So let's first understand your tax situation in US. So this is the current tax brackets. You notice the first $10,000 you earn, if you're single, 20,000 if you're married, you only pay a 10% tax. As you earn the next 10,000 to 40,000, you pay 12% tax. So it kind of goes, the tax bracket goes like this. The highest tax bracket is 37%. And start with 10%. You can see how, as you grow, the next dollars are in a higher tax bracket. So this is just for federal tax. Then you may have state tax depending on where you live. So if you make more than, $600,000, married or 518, then you're in tax bracket. So, most normal people will be somewhere in this range. Of course, some rich people will be above that range, but that gives you an idea of what the tax is. Then long-term gain, you have a different tax bracket. What's a long-term gain? If you hang on to an asset more than a year and then you sell it, then your gain is not taxed at 37 or 31%. It's taxed at, depending on either 0% up to first $40,000 or 15% or maximum 20%. So that's pretty sweet. Instead of paying 30% tax on federal, you can up to $441,000, you pay only 15% capital gain tax. So this applies to your home, this applies to your stocks. So there's a strategy. If you buy stock, if it's appropriate, you hang on to it for more than a year, then your tax will be a capital gain tax, which is much less. So, yeah. So ask me any question about tax rate, don't be shy, because I don't know which of these things are relevant or useful to you, but tell me. I'm putting those two pieces of data together on a single chart so you can see if you're individual or married, that your tax bracket for capital gains are very attractive compared to the ordinary income tax. So this will tell you that you will be able to make some decision to hang on to an asset like a stock more than a year, if that is favorable to you in tax gain. So by the way, if you think your taxes are high, your taxes are one of the lowest there are. Take a look at this chart. That's the historical federal tax rate. Can you believe there was a time around 1940s and 50s when your top bracket was almost like 90-some% during the Eisenhower and Truman days? Then slowly it came down. In 1982, this is where the Reagan brought it down, and that came down further. They went up a little bit, but it's still historically low. So just that you don't feel bad that you're paying a lot of tax. You're one of the lowest tax compared to historically where it has been. Now, it turns out, let's talk about states. There are 7 states which have no income tax. So if you live in Washington or Nevada, then that federal tax is all you pay. In California, it's one of the highest, 13.5. The highest tax bracket is 13.5. So good to know. That's why a lot of people move to Florida. Not a lot of people don't move to Hawaii because Hawaii is 11%. Florida is 0%. So you know why people go to Florida. Now, just for fun, this gives you an idea that what is the tax rate and different things. So you can see Hawaii is at 11%, California at 13.3, Washington is 0. So that should be a good chart for you to know where to live, especially when you're retiring, because this makes a difference. And some states don't tax the Social Security income, some do. So that could be a very interesting choice also. What about sales tax? So there's some states, 5 states, which don't have sales tax. So Oregon doesn't have sales tax. Washington doesn't have income tax. Is there a state which has neither? No income tax, no sales tax? Wouldn't that be nice?
Utopia, I guess.
Sorry?
Utopia, I guess.
Which one?
No, sorry, I was just kidding. I was just saying Utopia.
Utopia does exist. So you are not far off. There is one state which has no income tax and no sales tax. Your favorite, Alaska. So yeah, there's a reason. So there's Utopia does exist. So you just like to live in Alaska. Anyways, back to our topic. So question is, what's the difference between, by the way, I just threw this slide in for randomly. So this is called 529 plan. So some of you have children, you're thinking about college. This is one option you may consider, which means you can throw away some money into a bucket. It's called 529. It grows tax-free till you take the money out, I think. And depending on the state, some of them are still have other incentive. 34 state gives you put money away for college. They also give you further incentives. but there's no pay no federal income tax when money is withdrawn. So suddenly, if you put away $500 a month, it can grow to 117. But if you put in 529, it may grow more, and then you can pay. So nice thing is flexible. You can pay for college for your children, even grandchildren, even some special courses. You want to take a cooking class, chef class, even that qualifies as education. So there's a lot of flexibility in 529 pound plan. You may want to Google that in case you were getting excited about college savings. So let's describe what are these things and what's the difference. So individual retirement account, when you can put away some money. So idea is you can put money now, and it is $6,000 per person, 7,000 if you're old, more than 50 or 55, and this reduces your taxable income. So suppose your taxable income was $100,000. If you're putting money for IRA, $6,000, your taxable income becomes $94,000. So you're going to pay less tax. Suppose you were in 30% tax bracket or 22% tax bracket. So suddenly you saved money by paying less tax. You're paying tax on 94,000, not on 100,000. So then money will grow over time when you take it out, and you can take it out after age 59 and a half anytime. And you have to take it out after 70 and a half or 71. Now you pay tax when you take it out. So you put in, let's say over the years, you put $50,000 slowly. When it became $250,000. So let's say every year you take out $10,000, $20,000, you just pay tax on that 10, 20, whatever you take out. So it grew all this time without having to pay tax every year. So that, because if you had 50,000, if it became 55, you have to pay tax on the $5,000 gain. 55 became 53. Not if it was an IRA, there's no tax. So 55 remain 55, you earn another 10% on top of 55. So it keeps growing at a higher percent rate. So that's the point.
So can you move to Florida like now if you're about 59 and then skip the state taxes on this?
Yeah, if you move to Florida after age 60 and start taking money out after, you will not pay state tax because taxes are due when you take the money out. So yeah, you can live in California, and then when time to take money out, you move to Florida or Washington State and start taking it out. You avoid the sales tax. So a friend of mine whose company went public a few years ago, he moved to Miami instead of California, changed his residence to Miami. And he told me he saved $53 million on income tax just by moving to Miami because he was a Florida resident when he started taking money out. So it could be a very sweet decision. Okay, so we just talked about how IRA works. You put money away, it grows. So benefit number one, you reduce your taxable income. So you have some benefit right up front when you put money away. Number two, it grows faster because you're not paying tax every year on the gain. And number three, you pay tax when you take out. And hopefully when you're retired at age, whatever, 60, 51, 70, hopefully you don't not earning the big fat paycheck, so your tax bracket may be lower. So that's a good thing to do. There's really smart thing to do. Somebody had a question? So now my question is, okay, that's IRA. What the heck is Roth IRA? Should I be, who's Mr. Roth and what is Roth IRA? Well, Roth IRA is slightly different. Roth IRA says you invest post-tax dollars. So when you put in $6,000, it does not reduce your taxable income right now. You pay the tax and then you put $6,000 up to 6,000. But the good news is when you withdraw, that is tax-free. Meaning, suppose you put $50,000 over the years. When you became $250,000, when you took it out, you start taking out $10,000 every month, $20,000 a month. That is tax free. So regular
it's
IRA, you take some advantage now. You pay lower your taxable income. When you take money out when you retire, then you pay tax. Roth, you pay tax now. When you take money out, no tax.
and it still grows tax free, right?
Correct. So it's even more attractive.
So Naeem, how do you decide? Let's say you're just starting your career in your 20s, and you want to put away whatever the government allows, into some retirement savings. How do you decide whether to go regular IRA or Roth IRA?
So I'll answer that question in about 4 slides, but let me give you a short answer. Short answer is, in the beginning, start with a Roth IRA. When you start making a lot of money, then switch to regular IRA. Let me give you the reasoning. When you're starting out, you're not making as much money, so you'll be already been at some low tax bracket, 10, 15, 20%. So yes, you get some tax saving up front, but if you were already making, $200,000-$300,000, you're in 30-some% tax saving, then it's a bigger saving. Because Roth may, when you take the money out, let's say that money grew to $1 million. That $1 million will be taken out tax free when you're retired. So also Roth has a limit. If you make too much money, you cannot put money into Roth. So Roth is designed for people with medium to low income. I think the crossover point I have to check again, but a couple of years ago, it was if you made more than $120,000 a year, then you were not allowed to put Roth and take advantage. So, and it may have gone up to something, but there is some limit between 100K and 150K. So if you make more than that, then you're not allowed to Roth. So some years when I was not making as much money, I put into Roth. When I made more money, then I put into regular.
Talking about that, you were giving an example of your friend. So where did he? Were you talking about one of these retirement accounts that he had?
No,
okay.
no, he just made a lot of money.
Because these are very low limits, right?
That was he just made a lot of money taking the company public. So question is,
Gotcha.
when did you sell it? Nadia asked the question, can we start a Roth IRA for our kids? Answer is, you have to have earned income to put monies away to mine, if I'm not mistaken. Do you have to earn money? Definitely applies to 401k. Can you put money in?
You do name, yes. I don't know much about these things, but these are 2 things I recently looked into.
Yeah.
So yes.
With kids who are not earning money, you cannot put. But what you can do is you can put money away for kids for another instrument, like 529 is one. 529 is for college, so you can put money away. That grows tax free. So again, to state what Asim just confirmed, to put money into Roth or IRA, you have to earn that much money. So if you haven't earned $5,000, $6,000, you can maximum you can put is what you earn. So if you don't have a job,
isn't it a thing that if you open a custodial account under your name for your kids as a Roth IRA and you keep putting the money for them, I think that works in America.
I think you're right. It does. But
yes,
talk to
custodial
Schwab.
Accounts work.
Yeah, I'm not an expert. Talk to Schwab. Yes, you're probably right. All right, let's cover other topics here. So you understand the difference here? Okay, what is self-directed IRA? Self-direct means, you work for company A for a few years, you put some money in some account, maybe 401k or something. Then you work for company B, then maybe you even have some other thing. As you leave the company, you can roll them all into one rollover IRA. So this could also be what's called self-directed. Then instead of a company deciding where to invest your money, you can decide where to invest the money. So I have done that. I have with different people I work for. I put all the money in Schwab into a rollover IRA, which I can direct. I can decide where to invest the money, what to buy. So that gives you a lot of control. And all you have to do is go to this financial institution to say, please help me roll over. They do all the paperwork. You can consolidate your money. You don't have to have 5, 6 different retirement accounts dispersed everywhere.
Can you put money in your 401k in the current company that you're working in, as well as something in the regular IRA that you have, consolidated in the past at the same time?
Well, So what if you're consolidated, you cannot add to it. You have to add to one of the qualified plans. So
Oh,
I
okay.
have a bucket, which is all the X companies as one. I cannot add to that anymore. It's just
Okay.
growing by itself. Then 401k plan is only offered by an employer.
Okay. Okay.
So there you can put up to 20% of what you earn into a plan. Is again regulated. So and many companies actually, many profitable companies, large companies, not small companies, they contribute. So if you put some amount, let's say first 3% or 5% of your income goes into this bucket, the company will also contribute some 3%, 4%, 5%. It's like free money. Now, startup companies don't contribute because they have no profit to contribute, but large companies like Cisco, IBM, they encourage people to start saving for things, so they contribute, they match you. So it'll be really silly not to take advantage of that. This is free money. So find out if you work for an employer, how much do they contribute? If so, how much? What do you need to do? So you can put some money and company will contribute, and that is like free money, and then hopefully will grow. So I think the limit is like 20, it changes every year. Something like 20% of your salary up to like maybe it's 18.5, some close to number, you can contribute to a 401k.
I think it's 19,500 for 2021.
It changes, so yeah, 19,000 now.
Then if you're 50 and above, you can do catch up.
Yeah, then you can put it initial $5,000-$6,000. The point is the first $19,000-$20,000 you want to put in, and especially if the company matches, that's a no-brainer. That's a minimum you should do. Whatever the matching is, do that. That's free money. But if you have done that consistently, but from early days, this will become your big nest egg. If you start putting this 20% of what you in from day one, you will be a multimillionaire by the time you're 50 years old. There's no doubt. And then you can, based on the plan, you can invest this money into multiple things. You can put them in stocks, into bonds, into mutual funds, into ETFs, into either just bank savings account. You have many options to pick from how you want to distribute that money. But if you were to start, my first advice is start with, especially if the company matches, start with one of these things, 401ks. If company doesn't offer 401ks, then you can do IRA or Roth IRA. And then if you work for like a school or a university, then they also have 403bs, which is kind of like 401ks. But there's a maximum how much you can put away. If you have run your own business, then there's even more instrument, like I don't even want to even confuse you, but there are simple IRAs and this and that. The point is putting money away and letting it grow tax-free is a really smart thing to do. You'll be unwise not to take advantage of it. That's sort of my high-speed summary of that topic. So before I go to our last topic, what questions, if any, I can answer about retirement accounts, 401k, this, that, whatnot? So we covered stock market, we covered how to trading strategy, we talk about ETFs and stocks and mutual fund, we talk about 401ks and various tax strategies. Everybody happy with those? Do we talk about options? It's kind of an advanced topic here. Some of you may get bored with this topic, so feel free to leave. If not, I'm jumping into it. Okay, so what is an option? Option is a right to buy a block of shares of a publicly traded company at a given price by a certain date. You're not buying the shares, you're buying the right to buy the shares or sell the share, buy or sell. So think about that. Suppose you wanted to buy 1,000 shares of Google. Google is trading at what, like $1,100, $1,200, something like that. So 1,000 shares will be like $100,000. Not a lot of people have $100,000 lying around. But you could buy the right to buy 1,000 shares of Google at a certain price by a certain time. For example, they sold in the block of 100. It's called one contract. So 1,000 shares will be 10 contracts. You can buy, right to buy. This is called a call option. Call option is a right to buy. 10 contract. Each contract could be, let's say, by June of 2021 at $1,200. This right, I don't know, we can look it up how much it is. This right may be only $10. So somebody who owns the share is willing to sell you for $10 a right to buy at that price by that date. Since you're buying 1,000 multiplied for 1,000 shares, so for $10,000, you are controlling the right to buy the shares at certain price. So if Google goes to $1,400 by then, or some anytime between now and then, you can sell the right to somebody else. And that right, if Google is $1,300, this right will go to, is $100 above the asking price. This right will go for $100, $110. So your $10,000 become $100,000. To summarize, instead of buying the actual shares, you can buy the right to buy the shares. And you can sell that right to somebody else in the future. So you can make a lot more money because of leverage.
So the only thing you're ever trading so the only thing that you ever trade in options is just the right. You don't actually trade the underlying equity.
Yes, you can exercise the right and buy the underlying thing. You can.
Yeah,
but you don't have to. By the way, going back to Khalid Siddiqi's question, the 6,500 is for IRA and Roth IRA limit. The 24K or 19 and point and a half plus what is for 401K. So 401K has much higher limit. So that's going back to Khalid Siddiqi's question. Okay, back to this question. Yeah, we can actually look at this even just for fun. If you guys are curious, we can actually go there and look at, we were Yahoo Finance. Let's just see what is the actual number. Let's go. We can look at Apple also. Well, let's look at Apple. We're already at Apple. So look at options. So what it shows us under option, okay, this is option. So let's say this is for March 5th. Let's go to a little bit out. Let's look at a little bit later. Let's say September of 2021 or July, pick a number. Let's say, so for between now and September 17, I could have picked a different date, but could have picked as little. They by the way, expire every Friday. I can buy for next Friday, 2 Fridays from now, 3 Fridays from now, 4 Fridays from now, 5 Fridays from now. I can pick any of these days. Just for fun, I picked September. But maybe we'll pick that, we'll contrast it. Okay, this is September. So just look at this number here. So Apple stock, if I'm right now, Apple is sharing at what price? 121. I can buy the right to buy Apple at $125 between now and September for $11.74 or $12. So people think Apple is going to go above 130, 137, 140. So they're willing to pay $12 to have the right to buy it at 125.
Name, just about anybody can trade options, or do you have to kind of qualify?
You kind of have to qualify. You have to,
have a portfolio that.
Yeah, I mean, it says it's not a difficult exam you have to take. It's like I'm with Schwab, so I had to say, am I an experienced investor? Do I understand the risk? I had to answer a bunch of questionnaire, and then I was approved. But I'm sure on some other platform like Robinhood, maybe they don't even ask any questions. But yeah, that's the point. You do have to make sure that you're not just goofing off and then going to complain and blame other people. The point is, for between now and September, a lot of things can happen. So that's why the premium is about 120. Is about $12.75. Let's see what is that. If I just talk about next Friday, March 5th, then premium will be less because this time is less. So 125. That premium is $1.18. So between now and next Friday, people think stock price may go up to 126, 127. They're willing to sell you the right to buy at $125 for $1.18. You notice this number was like $12.75 till September. If you go even beyond September, it'll be more expensive. So people can write a buy to buy shares for $140 is only like 4 cents, because nobody believes stock of Apple is going beyond 142 in the next 1 week. But some people do, because for 4 cents you can buy that right.
Why are there so many different, like, why are there so many different rows? Why is there not like one row?
This strike price, at what price are you willing to buy? So willing to buy at this price is this is the price. So at $121 is $3 cents, 122, $2.59. So there's an arbitrage of time and premium. So you have to, and there's people much smarter than me using complicated algorithms to pick where is the arbitrage the best, where should I buy?
So if for the 125 example, if the price goes down, my maximum loss would just be the $1.18.
Exactly. That's exactly, you got it. So this is why I love this. Let me just say that for everybody understand what we just said, that the beautiful thing is, if stock doesn't go above that number and stays below, all I lost was that what our premium I paid is $1.18 per share. So for 100 shares, that's $118. That's all I can lose. If I had to buy the shares, I need thousands of dollars. So it's the ability to control a block of shares with a small amount of money. And if stock takes off, then that money could be multiplied several fold. You can make a lot of money. It's called leverage.
But I have a question, like before you buy the call option, do you look at the Greeks or not at all? You just go.
Do you look at what?
The Greeks, the theta, the vega, the gamma, all the values, do you look at those or no?
Well, you can look at whatever you want, whatever gives you comfort, what you believe in. I don't look at any of those things, because a lot of that is, to me, is like BS, but what do I know? But yeah, whatever you want to believe in, what stock, I mean, look, if it was that easy, everybody knew by looking at Greeks or whatever, if stock is going up or down, then everybody would do it.
But that's the concern. Like if the stock doesn't go up and your expiry is like next Friday, and you're losing, right? Basically, you're not making any money. And if you keep doing that, you're losing more than gaining anything, right?
That is correct. That's why, just like anything else, if any game you play, if you keep losing, you probably stop playing it after a while. So obviously people who do options, they do believe, or whatever method they use. By the way, the Greek she's talking about, I don't know all the Greek letters, but alpha and beta I do know. Alpha is a indicator of how good is the management of the company. It's a kind of indicator, and beta is the volatility of a stock compared to an index like S&P 500. So a company like PG&E is less volatile than S&P 500. It will have a beta of 0.7, 0.8. But Tesla, which is highly volatile, will have a beta of like 2.5 or 2.6. So that is an indicator of volatility. So these are different metrics people follow. But point is, whatever metric you believe, you only will do that if you believe stock is going up. So you will then do options accordingly. I made a lot of money just selling Apple. I used to buy Apple call options in August, September, and sell them before January announcement. And sort of predictably, every year they went up. So I stopped doing that now. But let me give you a little bit more knowledge, and then you can ask more questions. You see, longer far out it is, the premium is higher as you get closer to the expiry date. So this is like 120 days before the expiry, premium was much higher. As we saw in Apple's case, in September, the premium was $12.75. For March 5th, a week from now, premium was $1.18. $1.18. So premium goes down as you get close to it. So let's look at some other data. So that's the point, that how many months out, you can even buy option 2 years out. So, whatever. So if option is way out, then you can, you'll pay higher premium, but you can intelligent people start computing the arbitrage. So then the words to remember is strike price, at what price you're going to buy, and expiry date. The mistake to make is forget the expiration date. Then that will definitely expire worthless. Actually, giving this lecture, I just realized I bought its option on a stock called Vexert, and I had forgotten about it. I better check when are they expiring. So good thing. Note to self: checks my own option trading strategy. I almost
What
forgot that.
happens if you forget?
Yeah, you do so many things in there, you forget.
No,
So
no,
I
no.
need-
What I meant was, what happens if you forget?
Then
Then,
they will expire worthless.
oh, you have to exercise it.
Yeah, you have to do something. You have to buy the option, sell the option. You sell to close, buy to close. You have to take an action.
I see.
So
So there's no way to do that automated either.
I guess you can hire a stockbroker who will call you.
No, no. Okay, but it's not on the platforms.
Not the platform I use. There may be some fancy platform
Got
because I use Schwab. There's no notification. I have to remember it. Yeah, there may be some fancy platform do that. I don't know. Probably
see.
should. If not, there's a good opportunity for somebody to create such a alert system. That'll be a good thing. You can people subscribe for $5 a month. Just send me alerts when different things are happening. Not a
The
bad.
Ameritrade does that. They will send you a notification if your stock is expiring that week.
Oh, good. I gotta check with Schwab on this one. So put options are opposite. Call option was a right to buy that share. Put option is right to sell that share at a given price by a given time. So people who buy put option, they believe the stock is going down. So they can buy right now. The stock is, you think stock is $100 going down to $70. You can buy a put option and you can force somebody to buy from you at the strike price. So you can sell an option, a put option is right to sell to somebody at $100. So even if the stock went down, they have to buy from you at $100. It's the opposite of call option. So people use this strategy, and here I have what I showed you in the real life. This is a picture. It shows you this is what's the strike price 3 days from now. Apple was at 127. So you can, so what is the strike price? $1.75 at that price. What I just showed you, then January 29, 10 days from now, they would higher price. So all this data is available for free on the internet. You can look it up, bid, ask, strike price. So $128 strike price, your last trade was $1.78. If you want to go down to $130, it was $1.08, so on and so forth. So leaps are long-term option. So this is, I can buy, for example, all the way to 87 days out, even 2 years out, I can buy. Of course, premium will be higher because there's a more chance that things can happen. You can buy it, 38 days out, 59 days out, 87 days out. Here is I can buy it for January of 2022, 367 days out. Obviously, you can see the premium is $19 for me to buy or sell Apple at 127 because people believe in next 1 year, a lot of things can change. Stock could go $300. So if you buy at $19 and stock goes from not 127, but 227, I can sell this option, this right to somebody at $100 a share because this tracks the stock price. So I quintupled my money. So there's not easy to quintuple your money, but in option you can if the stock takes off. So if you're owning GameStop or something like that, you could have made $1 million. If the stock was multiplied, if you had an option to buy GameStop and it took off like 1,000%, you could have made a lot of money. So yeah. What else can I show you? So this is my last topic. One of the safest way to make money in stock market is writing covered calls. Covered calls are you actually own the share. So you're covered. And you can sell somebody the right to buy the share at a higher price. So if stock goes up, you make you bought the stock at $100. You're selling somebody right to buy from you at $120. If stock goes up to 120, 130, 140, they'll buy it from you at 120. If stock doesn't go to 120, it stays at 110 or 105, they will not exercise the right. You just collected the rent. So think about that. You cannot lose money, possibly lose money writing covered calls. That's the safest way to invest. If you're lucky enough to own the shares, you can rent the shares, keep collecting the rent till somebody buys from you at a profit. Only thing you lose is the additional profit you could have made had you not sold the option. But there's no way to lose money on writing covered calls. So this is like sometimes not obvious to people. That's quite stunning.
Does that transaction have to take place on the same platform as the buyer and the seller?
I'm confused with the question.
If I bought this stock in my Robinhood and the person is buying it through Robinhood, or they're
Yeah, through Robinhood, yeah.
I
The
see.
same, I think answer is same platform.
Same platform. Okay.
Yeah. So, this is an example of the leverage. So you own 200 shares of Apple. Okay. Now you can sell covered call, which expires in December at 120, and you collect the rent of $4.95. I'm showing you, right? $4.95 was the price of this option. So somebody paid you $990 to buy the right from you. Let's see what happens. A couple of things can happen. Stock stays below 120. You just made $990 rent, you still own the stock. Got it? Scenario A. Scenario B, stock goes above 120. You still made the rent, $990, and now you sold the shares at 120, you made $24,000. You bought them at less, you bought them maybe at $100. So you made rent plus you made the $20 gain. You can't lose money. What did you lose? Somebody say, okay, what's the catch? Catch is, suppose the stock went to, suppose stock went to 140. What you lost was because you will sell the shares from, you bought at 100 and you sold at 120. You could have made more money 140 if you did not sell the option. Okay, so you lost some potential gain, but you cannot lose money. You made this much money, $20 per share, plus the rent. And what people do is they keep renting the shares. They keep selling covered calls. So I can sell covered call for next Friday, collect the rent, then do it again next Friday, collect the rent. If stock doesn't go crazy, I can keep collecting the rent for the whole year. I may collect 10, in this example, this $990, I can collect it every week, every month. For over 10 months, if this was monthly, I just made $9,000 just collecting the premium by selling the call option. So if you own the shares, this is a great way to think about that. You own a house, you're renting a room on Airbnb. And money keeps coming in whenever you decide to rent it. You don't have to rent it every week. That's what it sounds like.
Are these the gains that you make trading options, are they taxed just like any capital gains, or is there something special category?
No, no special category. It's like there won't be capital gain. There'll be short-term gain. So it'll be ordinary income. Yeah. But the way what happens is that I think let me be more accurate. It reduces the basis for your shares. So you bought $100. Suppose you collected $30 in rent. So your basis for the stock is $70. So someday when you sell it for 200, your gain is not 100 to 200, it's from 70 to 200. So you pay tax when you sell, but this reduces the basis for your stock price. So translation, that it kind of becomes long-term gain when you sell it and not short-term. So I think we can stop here because we are at that 90-minute mark, because I'm just giving you just more example, but you got the basic gist of it. So this is just an example I just showed you before, that you can keep doing it for every month, every time. And you keep collecting rent every week, so you can collect lots of rent over multiple weeks. So guys, we can, any last questions before? So Yaya said, what happened is stock below your purchase price. So if you bought the stock at $100, stock is at 80, then other person will be silly to buy from you at 120. They will not exercise that option. So you will keep the rent, and stock is at 80, you still own the shares, you do nothing. You hang on to it. Hopefully someday it goes higher. So no loss, you still own the stock. Kamran, you have a question? Or your hand is up. Kamran, hand is up by mistake. Okay. So Casey, Abi, Zareen, Zeman, AQ, anything else before you say goodbye?
Thank you very much.
Well, good to hear. Hanif, fascinating.
Naeem, this is awesome. Thank you very much.
Thank you, guys. Good to
You
have you
too.
all.
Thank you very much.
Thank you, everyone. And I have
Yeah.
all the platforms like Facebook and LinkedIn on the chat window, so you can follow us and stay up to date.
Yeah.
Yeah, I just want to say this was amazing. I've seen some YouTube videos by other people, but this was way better. Thank you so much.
Yeah, you just
Thank you so
make it
much.
so simple.
Yeah, thank you, guys, because it's more interactive, so we can, answer questions, because there's a lot of knowledge out there, but it's not packaged knowledge, so it becomes overwhelming. So this is a place to come for simplify, answer your answers.
I think the fact
Zeman,
that
the
you can
first time
ask,
you're coming to an event at Open, how did you find us? This is Miss Zemun.
Oh, hi. I saw this on Eventbrite.
Yeah.
Oh,
Very nice. And was it useful to you? What did you expect, or not
Yeah,
quite?
sorry, I missed the first part. So, but I'm learning, and so this would be very useful in consolidating. Still a newbie, so lots to pack in. But thank you very much, Naeem. Thank
You're
you.
welcome, and you can get the recording and contact us anytime through Open Silicon Valley. We'll be happy to help you guys.
Thank you.
thank you.
Okay,
For joining.
bye.
thank you.
Bye, everyone. Thank you.